Alright, this video is going to outline the reasoning for a trade we're putting on right now with about an hour left to go in the trading day. The premise of the trade is we're short SPY, which is the ETF that correlates to the S&P 500, and our reasoning for being short is because of the VIX, the volatility index. The VIX has started to spike up towards the close here about starting half hour or so ago, and we are going to show you a clear inverse correlation between the VIX and the S&P 500. So therefore, we're betting on the fact that the S&P 500 will not be able to close in the green, or SPY rather, will not be able to close green if the VIX is able to hold on to its current gain. Furthermore, our thesis is the VIX will be able to hold on to its current gain because otherwise it wouldn't have made such a move so late in the day, right? Oftentimes we'll see the VIX rise 4 or 5% at the open, and then it'll give up that gain throughout the day. But rarely do we see the VIX start to spike towards the end of the day and give up any of that gain. Why? Well, because people are positioning for next week, and they're getting positioned towards the close, and clearly as evidenced by the spike in the VIX here at the last couple minutes, you can see this is a 3-minute chart of the day's actions today. Big spike starting at 14:12, so about 40 minutes ago or so, and it's really just carried on, and now it's going near the highs of the day. And remember what the VIX is. The VIX is a measure of puts versus calls on the S&P 500 being purchased 30 days out. So what would cause a rise in the VIX is a rise in puts being called versus puts being purchased versus calls being purchased, which causes the ratio to go in the VIX's favor, which causes the ratio to go in favor of the puts, which then causes a consequent rise in the VIX itself. So with that known, we can say, okay, right around 2:15 today, people started buying puts on the S&P 500 for whatever reason. Now, there's a couple other factors that we believe are working in our favor from the short side of things here. You can see on SPY, the high today was 137.20. Okay, the high back here in May was 137.18. So we've got, a little bit of a double top in place here as we've now pulled back. We're at 136.75, which, why is that number important? Well, it's where SPY opened the week at 136.73. So everything right now is lining up in the bear's favor, so we're going to go ahead and jump on that trade. And the way we're going to do it is with these puts right here, the 137 weekly puts expiring today. Now, you might say, well, why are we doing this instead of going out to next week? Okay, well, we do believe you could get short going into next week. We definitely are in that camp. However, we want to show that if we're correct here, based on our analysis that we've shown you with the VIX, and if SPY goes on to close near the lows of the day or below it, these puts here have the potential to get up to 40 to 50 cents, which would be a nice quick return of anywhere from 25 to 75%, depending on what goes on in the last hour of the day. So we picked these up right here at 28 cents on our other monitor. We're in this trade right now at 28 cents. So I'm going to pause this video and we're going to see how it unfolds. And the only thing that would really get us out of this trade is if we see SPY, pop back above this range 136.80, 136.90 range. Why is that? Why are we choosing 136.90? Well, because you can see that was support on this dip. So oftentimes you'll see prior support become resistance. So if we're not able to break back above, this 136.90-ish level here on SPY over the next half hour or so, then we will stay with this trade and stay with our target of these lows here all the way down to 136.50. Why 136.50? Well, SPY closed last week at 136.50, and you can see so far this year it hasn't had a down week. Okay, so if things are going to close red, so it actually closed at 136.41. So if things are going to close lower for us and go in our favor, then we would expect it to go back towards last week's close, which is 136.40. So our target is going to be 136.40 to 136.50, which would put those puts between 50 cents and 60 cents, which from an entry at 28 cents would result in potentially 100% gains. So I'll pause the video now, and we will see. Oh, and one last thing very quickly, just to show why we're relying on the VIX. This is a 5-minute chart of SPY at the top right here and VIX on the bottom right here. You can see very, very clearly the inverse correlation between SPY and the VIX. So the VIX spiked, and now SPY has come down, and now SPY is trying to rise, and VIX is coming down. So that's why we rely on an indicator like the VIX for a trade like this. So I'll pause the video now, and we'll revisit it shortly. Okay, really quick, wanted to update the position. So we're down at the moment from our entry at 28 cents. We actually added just now at 23 cents. Why are we adding? Well, because the VIX is still holding on to a good portion of this move, whereas earlier in the day, you can see here the VIX made a nice move, and as you can see, SPX moved with it, right? But it gave up all of those gains pretty quickly, you see. But here it's actually holding on to these gains for a longer period of time than this move there. And this was an even bigger move. So no reason for us to get shaken out of this trade just yet. And we're still below the resistance level that we talked about. So we averaged down. Our average is now 25 cents. And we're at break even right now. So pause it again, and we'll come back once we start getting more of a move in one direction or the other. Okay, we're starting to get some movement here in our favor. You can see our put options are up to 33 cents or so, 32 cents. And more importantly, the VIX pulled back, but it didn't give up all of its gains as it did earlier. It held on to a good portion of these gains, and it was able to now bounce back up, and we are close to the high of the day for the VIX, and this is keeping the inverse correlation intact. Also, you can see that we stayed below what we said our stop loss level would be on SPY. We talked about that 136.90 level. We couldn't get past 136.85. We came up to it twice. Couldn't break above it. So now we're just going to stay with this and we've got about 25 minutes left, 26 minutes or so left in the day. So we'll check back in another 10 minutes or so, and hopefully really soon we'll see the VIX move even higher, get back above that 1750 level. And if that happens, we should see SPY retest the lows of the day. All right, we've sold the puts at a small loss. Now they're down to 19 cents. We just sold them at 22 cents. Took about a 15% loss. Nothing big. And you might say, why are we selling even when the SPY didn't get above the level we talked about? Well, the reason is that while SPY hasn't broken above its level, the VIX has actually broken below this key low here that it had made. And the inverse correlation we showed you earlier leads us to believe that because of this move down in the VIX, we're soon going to see SPY break above the levels that would have stopped us out anyway. So because of that, we exited the trade. So this was a loser, and you know, those are a part of the game, but hopefully everybody still gets something out of this. And for the record, we would still maintain a short bias going into next week. The reason for that isn't because we think the market's going lower. It's never what you think is going to happen. The reason is that based on the best risk-reward scenario, you have a couple stop-loss points here. If you wanted to get long on the S&P 500, we would say that your stop loss is, you know, this 1350 area, because that was previous resistance, and now it's likely support. So that's 14 points away on the long side, versus if you want to get short, we would say your stop loss is this 1367, 1369, 1370 area, which we're 3 to 5 points away from. So based on that, your stop loss on the short side is 5 points away maximum, where your stop loss on the long side is 15 points away. So just, you know, which one is greater than the other, right? Obviously, when we explain it like that, getting short versus 1370 to us makes more sense than getting long at getting long versus 1350, since we're much closer to 1370. So our risk reward is clearly defined by using 1370 as a stop loss, and that would be our reasoning, and we would see how that plays out.